Get to the floor show. Our investors, Circle Squared Alternative Investments CEO Jeff Sica and JP Morgan Asset Management's Managing Director and Portfolio Manager Phil Camporelli. Phil, what do you make of this rally? It looks like it's even stronger than just, oh, there's a pause, because the Fed did say 2 more rate hikes coming this year.
Yeah, that was certainly the noise from yesterday's meeting, Liz, is that, oh my goodness, they're not done. They're not going to, just kind of go away. But here's the signal from yesterday's meeting, Liz, in our opinion. They also upgraded the growth outlook. So they took the growth outlook this year from about 0.4% up to 1%, and they dropped the unemployment rate forecast. Liz, the fundamental story is starting to coalesce around not only did we say that we're going to avoid recession this year, the Fed just said yesterday that most likely we're going to avoid recession, and 3 months ago that was a foregone conclusion. I think that's the signal.
Oh, everybody's been calling. Oh, it'll be a shallow recession. It'll be a mild recession. And we have not had a mild recession,
That's right.
A shallow recession. Jeff, though, I don't know, that retail sales number looked like it was kind of getting at a low boil. So is the Fed already wrong in pausing here?
Well, here's the way I look at the Fed. They seem to be always wrong. So this pause, to me, what I look at it as, first of all, it's no surprise to anybody. Everybody thought they were going to pause. They had pressure from all angles to pause. But what I see, and the fact that Jerome Powell said that they were going to potentially raise rates 2 more times, the first thing I thought when I heard him say that was nobody's going to believe him. Nobody is going to believe him. He talks hawkish, but he is, in fact, a dove. So, yes, there is a lot of reasons why the markets are moving up, and in anticipation that he won't follow through with the rate hikes, which could send us into a deeper recession, and as you talked about with Silicon Valley Bank, could create a scenario where the regional banks get annihilated by the portfolios.
But Phil is sitting next to you saying that the metrics do not look like a recession. I would tend to agree, and I brought this up. I keep bringing up Duke Professor Campbell Harvey, who invented the term yield curve inversion.
Right.
And he said, now we look like a hard landing because the Fed went too far. And I said, but things look good. These numbers look healthy. And he said, everything always looks great right before a recession.
Liz, you know what's been so great about this equity rally, though, is that in early March, we were pricing in about 80 basis points of easing this year. The first one was going to happen in July. We have priced all of that out. The Fed just said, you know what, we're not going to stop at 5.1 at the end of this year. We're going to go up to 5.5. And the market's saying, you know what? That's still happening in a world where inflation is moving lower.
Then
that
why
are
you neutral on equities, Phil?
Because we don't want to be overweight, because we don't have this bullish story of above trend growth. It is really hard to be underweight. That's what we're communicating with clients right now. It's really hard to be underweight the market because you need a hard landing view. But in order to be overweight, that's a tough story when the federal funds rate is so high.
And Jeff, listen, you've been a little bit bearish. And all the market's done is go up, up, up.
Well, here's the thing. You know what? I love my dog, and I've said this before, but my dog has terrible breath. And this market has terrible breath. When you have 7
but
stocks...
You don't kick your dog outside.
No, I love my dog.
Night.
My dog is my best friend. No, this market, 7 stocks are driving this market. You pull out these big tech, and what you have is underperformance of the market. To me, this looks remarkably like what happened in the dot-com bust. I'm not saying it's going to be to that effect, but it's looking like that. So I'm not going to trust the market that's relying on stocks like Apple, which has now exceeded the market cap of the entire Russell 2000.
Wow.
So I'm not going to, and exceeded the GDP of Australia, Canada, South Korea. To me, the big stocks can't stay in this leadership position without the value stocks and the rest of the market being able to have some momentum upwards.
But Phil, if you are neutral on equities, there's got to be a way to straddle the line and get a relationship between stocks and bonds for investors. What does that look like?
Yeah, so the stock bond allocation I think is really important here. The bond allocation probably not as bullish as we were on bonds.
Yeah, yields are coming down today.
Yeah, so that's part of the story, Liz. I think what Jeff highlighted is really important though in that stock bond relationship. These NASDAQ stocks like Apple last year are long duration stocks, right? So they got hurt at a time when rates were moving higher. We now have rates higher, and these stocks are holding in. The key is, if we avoid recession, we think that bad breath is going to turn into good breath, right? Or fresh breath. So you're going to get, we think, an expansion of the breadth of the market. It's not going to be as narrow. What Jeff highlighted is a really important risk, though.
Folks, at this price, $186, Apple is right at an all-time record. Gentlemen, thank you very much. Jeff Sica, Phil Camporelli. I love how Phil's like, you know, what Jeff said was important. You guys disagree, but we love that. We like contrarian views, so thank you very much.